How you doing? Emmett Dempsey, Treasure Coast Mortgage. Today's video is going to be on the September 2023 market update for interest rates, market updates for Florida nationwide. And this is the first in a series, so we're going to go over a lot of data today. Kind of show you some different things behind the scenes, kind of my philosophy, what advice I'm talking to my clients about. So, as you may know, rates are up than they have been. So let's go ahead and take a look at where interest rates are today, and here we take a look. So here's my website. There's me, old baldy here. So you go to here to tcmortgage.com. You can go to today's rates. Okay. So today's rates, on a 30-year conforming, 7.144. So we're in the sevens, 30-day range, from 6.9 to 7.22. So we had a lot of volatility. So that's been the name of the game. They gone up, they gone down. And what moves interest rates, different market data and inflation. So inflation is basically the number one thing we've been talking about. And inflation is basically too much money chasing too few goods, kind of the hangover from the COVID stimulus when they pumped a lot of money into the economy. Now the Fed raised interest rates in order to get that money out of the economy, and they're looking at other inflationary things like the labor markets to see when it is a good signal for them to pull back on their monetary policy, which would then have a favorable bond market movement in order for rates to drop. So I know that was kind of a lot of stuff, but that's kind of it in a nutshell. So you can see here, this is where rates are today and how we got there. So I want to show you this. This is from MBS Highway. This is an industry site, but you can go to like Mortgage News Daily. You can check out mortgage rates about where they're at today, 7.3. You can see that it's all just an average. And I'm going to show you a rate quote about how we take a look at stuff. But I want to kind of paint the picture as to where rates are. So what I like to do is usually the interest rates on a 30-year fixed they follow the 10-year Treasury roughly. So I'm just going to show you a chart about where we are. This doesn't really mean much, but let me go back as far as I can go. Just to see how far and how fast rates have risen. So we can go to the max here. You can see here in 2018 is when rates were higher. And the 10-year Treasury was in the threes, and it started to come down as inflation back then. We had an inflationary spike, and it came down. And then in 2020, after COVID, you can see here it dropped like a stone. So 10-year basically went to almost zero. And then in March of 2020 with COVID, and you can see where the 10-year Treasury and rates were very, very good. And then slowly but surely, they started to rise as the Fed, finally started to raise interest rates. You believe it early 2022, but generally interest rates will follow inflation. I'm going to show you another graph in a minute about that, but you can just see how they've risen and they skyrocketed. Once inflation skyrocketed, the 10-year Treasury skyrocketed. Because essentially, bond traders, what they are, they're bonds. Bond traders want to get compensated for their money erosion, which is what inflation is. So they're going to say, well, in order to buy these bonds, you're going to have to give me a higher yield to compensate me for the interest rate risk or the inflation risk. So that's kind of what happens. Is it's a market-based economy. So there's not enough buyers unless that yield rises. So this is kind of how what's going on here. And all these are lock alerts. This is just what we in the industry, recommend if you're locking or floating your loan, what we're doing. And right now, when you're getting contract, I'm recommending locking right away. So that's kind of it, how it goes as far as interest rates go. Okay, now, as far as what we do now, kind of edit that out. So basically, this is an example of how we quote. Okay, so this is how we quote rates. This is called a mortgage total cost analysis. So this is for one of my clients. So essentially what I would do, this is an FHA loan. Here's your 7%. Usually these are like no point fees or are very little points built into it. So this is 7%. 2832 payment, 33,000 cash to close for a 338,000 house. Okay. And you see the different other rate options, about 6.5% or 6.25%. So obviously, the lower the rate, the more the buy down. And this is what I show. And then you can see, is the monthly savings worth that extra out of pocket cost? And things like that. Now, this fourth column is what's called a 2-1 buy down, and I have other videos on my channel about that. Essentially, you're getting money from the seller, roughly 2.5% of the sales price, in order to fund your temporary buy down, where for a fact you're going to start 2% lower the first year, 1% lower the second year, then it goes back up to the note rate, and there might be a long enough time, for to wait for rates to come down, as we expected they will. All right, so you can see it starts off at 4.25. It's at 5.66, difference in the 7%. So it's a much different payment picture. So this is the way I've been working with my clients to get seller credits, get them into 2-1, sometimes a 3-2-1 buy down. We get enough seller credits. That's what we're working on. All right, now as far as markets go and inventory, so a lot of times there's a lot of folks here on YouTube that just want to talk about crash, crash, and also if you would just go ahead and leave a like in this video and go and comment what you think so far about interest rates and what you've seen. So you see these, we call them the crash bros. So they just talk about crash all the time, and they just say market's crashing because they harp on certain things. Like existing home sales, and I'm going to show you that in a minute. So basically, existing home sales, they receded 16%. So yeah, they're going to say sales are dropping, we're going to crash. Well, of course, because of less inventory, there's not enough things to sell in order to drive sales. And I'm going to go over some inventory stuff, about what the data shows and kind of how and why we're here, and that in a second. So basically, yes, home sales receded 16%, and here is state of Florida, for the state of July, because I'm licensed in Florida and Georgia. So if you're looking to buy or sell a home, definitely give me a call. I'd love to help you. And if you're in another state, I just haven't gotten to you yet. I haven't been licensed in those states, but if more of you reach out to me to help your family with their mortgage, I'll definitely get licensed there. So, this is where we are in July of 2023. We're down, but what I see is the median sales prices hasn't really moved. The sales price isn't down because sales are done, sales are down, demand is down, so they've kind of matched. So we're kind of in a frozen market. I'm right here in Port St. Lucie where I'm at, and this is for July too. We're down 1.7% in closed sales, but our median sales price is barely budged. It's negative 0.1%. Our average sales price is up because the higher price homes, are kind of in a whole different market. So it's moved in St. Lucie and Martin County. So that's kind of what we saw there. But as far as the inventory goes, this is the biggest one. Now, 6 months is a normal inventory level. Just so we know that. So basically, you can see from 99 on through now. We haven't had 6 months, only just those run-up months just before the 2008 crash. And you can see right now we're at 3.3, and I can show you in those other graphs how we're even lower here in Florida. But the biggest one is this one. It's the average annual units completed from 1970 through 2020. So right here in the late 90s, leading up to 2008, rising. We had too much supply, not enough demand. Generation X, is my generation. Back then the median home buyer was 33 years old. There weren't enough people to buy all this supply, so we had an oversupply under demand. And then the builders kind of went away. So I don't know about in your town here in South Florida, the builders were everywhere in 2007, and then they vanished, gone. Like all the model homes, along certain avenues, I'm sure you can see in your town, they're all bought by homeowners, and they were gone because we had 14 straight years below the 52-year average. So basically almost 15 years of under the average. So that's kind of how we've arrived there as far as the building. I mean, everybody's thinking about, well, right now I see builders everywhere. It's like, yeah, now, but for 15 years they were gone. So they're playing catch up. And who knows, how long it's going to take for them to actually, meet demand. So there's that. And then also, on top of inventory, is people are staying longer in their homes. I know for years when I started 2007, it was like the average home buyer stays in their home 7 years. It's like, 6.1 was actually overshooting. It was 6.1. Now it's like 9.3. So they're staying a lot longer in their homes. So there's that. So wasn't enough inventory to begin with. They're staying in their homes longer. And let's take a look at this as well. An interesting stat. 70% of homeowners have mortgage rates less than 4%. So why are they going to sell? So the common retort is, I don't know where I'm going to go. My rate is good, because of where rates are. So until this rate comes down significantly, these folks who are sitting here, why would they move? That's kind of in a nutshell where we're at with folks. So so they have low rates. Number one. They're sitting on a mountain of equity. Basically almost 68% have paid off their mortgages, at least 50% equity. So where are all the distressed sellers? These housing crash bros, and say, hey, we want you to, we need all this stuff. So that's what the inventory is. Okay, as far as interest rates goes and your interest rate relief, here is this graph here. Inflation in the 30-year fixed rate mortgage. Now, what happens is as inflation goes up, interest rates go up, but it doesn't happen automatically. It's a lagging indicator because they have to look back at data, from months ago to see. And you can see in the 70s, when inflation went up, okay, they trudge, and then rates went up, and then inflation went up even more. You can see it's a lag. And then when the blue inflation came down, rates stayed elevated for another year or two, and then they started to come down and started to follow inflation. So rates will eventually follow. And here we are right here. Rates shot up to where we're at, and then inflation has been dropping like a stone. So we expect rates to drop eventually. There's no guarantee as to when that might happen. I've seen as early as 25, but when the beginning of the rate handle starts when the fives and the sixes and the fives, I think some it's going to thaw the market a little bit, and more inventory will come to market. So if you're looking to buy a house, more inventory to the market. But it's going to bring everyone into the market. So I've been recommending to folks that, yes, inventory is tight, but if you can afford the payment and it's right for your family, take a look and do it now, and you can always refinance later, because inevitably rates will drop. So that's kind of it in a nutshell. And of course, if you're looking to buy or sell a house, especially here in Florida, I'm also licensed in Florida and Georgia, and I'd like to help your family next. Then definitely give me a call. Go to tcmortgage.com. You can book a call. All the links are in my description here. Thank you so much for watching, and I'll see you guys in the next one.